Good morning and welcome to this edition of ABI's Brunch and Learn webinar series. It's a pleasure to be here today. Thanks for joining us. I'm just going to give you a few housekeeping orders here. You see the PowerPoint presentation in the middle of your screen. Below that is an opportunity to provide any comments or questions throughout the presentation. That is also a place for you to put your contact information, and we can provide you with the information after this presentation. So let us know if you have any questions throughout, and Jim will let you know if he'll handle those questions throughout the presentation or at the end. And it's also my duty and pleasure to thank the folks at MyEntrenet for all their technical expertise for this and the platform through which we deliver these webinars each week. So it's my pleasure now to introduce Brooke Rosenberg. As you know, ABI is blessed with a group of advisors that meet monthly, and their sole exclusive purpose is to brainstorm around issues facing our members and their companies. And so Brooke is one of those folks, and other folks from AFR, and they truly do look at the risks of an organization from a holistic perspective. And so they sort of take a commodity, which would be property casualty insurance or employee benefits, and they expand that to really take a look at the full breadth of risk facing organizations, and they do a fantastic job. Brooke is a current partner in Harold Fay Rosenberg, and he started in the insurance business in 1973. Shh, it's giving it away, isn't it? Because I'm sure they thought you were 24. And he's
a year older than you.
Exactly. He's a fourth-generation insurance broker and specializes in employee benefits, with his main focus on the implementation, education, and communication of benefits both to the employer and the employees and their families. They have clients all over Iowa and in an additional 15 states. So thanks for being here, Brooke, and we've got a guest that you'll introduce.
Up to me now, huh? All right. Well, I'm excited about this presentation. We have Captive Resources, Jim Merkel, here via the wonderful technology. I want to give a little background on Captive Resources. They've been part of that industry for over 30 years of member-owned captive insurance companies. They've created over 25 groups, captives that serve the business and organizations across the United States. Today, Captive Resources proudly administers 5 of the top 10 captives in the world, with premiums of over $1 billion. Managing with assets, those captives have assets in the billions of dollars. Their newest captive, Well Health Insurance Limited, which Jim is going to review, was formed in April of 2011, is a member-owned captive for the leverage of benefits of self-insured health plans. That captive was first started, as I said, in April of 11th, had its first member of June of 2011, and has really taken off since. So I'm going to turn it over to Jim to make the presentation and answer any of your questions. Jim there? Uh-oh. I may be having difficulty. What do you... Well, we had Jim a minute ago. It sounds like he's talking. I can't hear him. Well, I just see on the screen that Jim's typed in all capitals. He's not hearing anyone, so Rob is trying to figure out what the problem is, and we'll get it corrected as soon as possible.
Yeah, just like that on you. Okay, that's fine. Oh. Okay, thanks. Good morning, everyone. Brooke, I'm sorry I didn't hear your introduction, but whatever you said, I appreciate it. Thank you. I am Jim
You're
Merkel. I
quite welcome.
work at Captive Resources. Captive Resources has been in business for about 30 years, and we strictly work on captive programs that are member-owned group captives. And there's a lot of definitions out there of captives, and let me just kind of give you the basic definition for us that we use as a captive, and it's an insurance company that provides insurance to and is controlled by its owners. Pretty basic definition, but it is very important. The key component of that is it's owned by its owners. So today, I'm going to be talking about a captive whose structure is strictly around stop-loss coverage. Our target account size for our program that we're looking at are currently accounts that are self-insured or that want to be self-insured and have the ability to get historical loss data, which is critical. We're looking at accounts with about 75 enrollees up to 1,500 enrollees. And the accounts have to be willing to take on a spec deductible somewhere between $25,000 up to $150,000 spec deductible. So it's kind of our parameters for the program. We currently have 21 members in the program, right around $5 million. Our average account size is right around 200 members. During the presentation today, I will go through the presentation and then try to answer any questions at the end. Some of the questions as I go through that you might have, please type away, but I would expect some of them may be answered as I go through the presentation. So keep in mind the basic definition of a captive, owned and controlled by the owners. So Well Health Insurance Companies is a reinsurance company that provides reinsurance to a stop-loss policy written by our policy issuing carrier, fronting carrier, who is Berkeley Accident and Health. Berkeley Accident and Health will issue each member a stop-loss policy. Our captive, Well Health Insurance, will reinsure Berkeley for the first $200,000 layer of risk above each member's spec deductible that they take. So in essence, Well Health Insurance is owned and controlled by the owners, and that's a critical piece. The different types of captives that you may have heard about, and I just want to kind of touch base quickly on them, are single parent captives, and those would be the large, maybe Fortune 100 type companies that put together their own programs, and it's just one company. Rent-a captives might be insurance companies based, and they allow you a cell that you could participate in, but it is owned by the insurance company and the profits go to the insurance company. Agency captives have been very popular out there in previous years, and again, the key concept here is that even the agency captives, the ownership is held by the agency. The programs that we have worked on traditionally for 30 years are all member-owned group captives, and we have homogeneous captives, which is industry specific, heterogeneous group captives, which Well Health Insurance Limited will participate as a heterogeneous group captive, where each member has ownership. The important note here is that none of the service providers that take part in Well Health, CRI, the broker, your TPA, all the different vendors have no ownership at all in this program. The ownership is all with the owners themselves. So the common theme today is what's on the first slide here, taking control of your insurance destiny. And as we go through the presentation, we will kind of address all the issues that we talked about here. So keep in mind that taking control is what we're really looking at. We want proactive members, people that want to take a cutting edge. I want to thank Brooke and his group because they've always kind of pushed that envelope a little bit. We want to make sure that we're working with partners that are looking to be on the cutting edge and being the best of the breed. As I mentioned, we're independent consultants. We currently administer 27 group captives. We represent over 2,500 companies around the country, and combined premiums as of today exceed $1 billion. So we've been doing this right, and I guess the point to make here is our formula. What we look at is taking control, and that means all captives have some risk and reward element to it. And we will explain that as we go through the presentation. The Well Health is going to leverage the benefits of being self-funded with the captive insurance overlay. And what I'm saying is that in the traditional marketplace, your current program for stop-loss coverage is a fixed cost. You pay your premium, whether you have good experience or poor experience. You pay a fixed cost. Usually you pay that over 12 months. But it's once it's gone, it's paid. Our program, we're going to introduce an element of risk and reward, and I'll show you how that works. And our portion of the premium in our examples will be allocated back to the members themselves. So we're taking a fixed cost traditionally in the marketplace. The captive is going to add an element of risk and reward, and we're going to put a variable piece into the premium to allow our members that perform well to get some dollars back. What is the problem in the current industry? It's pretty basic. You guys have been experiencing it for years. Costs keep going up and at an alarming rate. This chart, if you can read it, it points out that over the last 10 years, health insurance is up 160%. The only one who's outpacing that is workers' comp. And I know I'm not in the workers' comp arena, but I know there's some changes going to take place that may impact that even further. So the dollars being spent on medical for either workers' comp or health benefits obviously is alarming. So why should it be important to us? We want to try to get control over it. We want to try to impact it as much as we can. I know you work closely with your brokers and your TPAs currently to improve your health management. A lot of different ways that you go about that today. Our program is going to just kind of supplement that. Obviously, there's no quick answer. This is a long-term battle, but it's one that we will work closely with our members to try to improve that. Any underwriting profits and investment income will be returned to the members themselves. Again, in today's traditional marketplace, all the profits go to the insurance companies. Our program has multi-state capabilities. We have members all over the country, so we had to put together a program that would allow us to work in all states. And our ultimate goal is to reduce costs. Well Health is a stop-loss captive, and that's kind of what's going to bring our members together. However, what's going to keep our members together is that we're going to be working diligently on these elements that affect the cost. There's a lot of homework and a lot of work that has been done. I'm sure you guys have looked at your plan designs very carefully currently with your broker, and we encourage obviously everybody to do that. Plan design, another element of that is your actual plan document if you're currently self-funded. Very critical piece of the pie, and one that we really want us and everyone to focus on. We will be pushing a lot of wellness initiatives and suggestions. Again, this is a member-owned program, so Captive Resources is a consultant and we bring ideas, but the members themselves will determine how they will impact that. We talked a little bit about sharing ideas, and to us this is kind of what's going to keep the program together. On our casualty programs, we've been doing it for 30 years. The members that get together at board meetings and workshops, It's very much designed to communicate with each other. You've got owners at these different meetings. They've gone through some of the same things that you're going through. They've worked on programs that maybe worked and maybe didn't work. They can share those ideas with you, but it's a great resource. We recently had a workshop with the members. The TPAs were invited, the brokers were invited. We had a really good participation. And as a result, we have a lot of wealth of talent in that room, and it helps us drive the initiatives and the focus that we're going to go forward with for the next 6 months, the next 9 months. And every time we get together, we're driving 2, 3, 4 major elements that we're trying to implement into our program. And again, it's driven by the members and their ideas and their suggestions. Other impact, and it's pretty significant, and it's really hard to put a number on it. I know, return on investment's a pretty big key out there, and a lot of owners like yourselves are looking at the dollars that you're spending and how much impact that you get. As you saw on that previous chart, the workers' comp dollars are going up as fast as the health dollars. And obviously keeping people healthy at work and keeping people healthy, period, is a very important element. These are kind of, we talked a lot about total cost of risk on the casualty side. On the benefit side, there's just so much impact, and it's hard to put dollars on it, but these are areas that obviously impacted if we have healthy employees. So we expect the workers' comp to improve, absenteeism, productivity, and one that's, not mentioned often enough, obviously, is just morale within your organization. Healthy employees, there is obviously a correlation there, so we have to determine exactly what those cost savings may be. Our program is designed to work with companies all over the country, so we had to come up with something that was very flexible. When we first designed the program, we looked at a lot of different options and opportunities. We talked to national carriers, national TPAs, and at the end, we decided that it was more important to work with local brokers, local TPAs. On the health side, it just made a lot more sense. So our program is designed for you to be able to use your current plan if you desire to do that. We're not going to dictate what's going to be your plan design will look like. That will be up to you. Again, we have certain limits on the spec deductibles that we have for our program between $25,000 and $150,000, but the account gets to pick which fits best for them. You can obtain stop loss aggregate protection if you like. Berkeley will be providing coverage for that, but it is outside our captive program. And that's an important element to remember. Our program does not contain the stop loss aggregate coverage. And the reason for that, I talked to a lot of different reinsurers when we were designing our program, and I did not want that exposure in our program. I'm looking for predictable losses, predictable risk, and I was too concerned that any large claim would have too big of an impact on our program. It was very difficult. Most reinsurers balked at that, didn't like that idea, wanted us to keep that within the captive, but we finally negotiated with Berkeley and were able to get that taken out, and that is critical. Again, we're going to focus on the wellness initiative. We do allow you to choose your own TPA. We think it's important to use the local because they have the best access and know the networks to work with. They know the best, get you the best discounts. So we really have decided that working with the local TPAs is the way to go. The only caveat is they must be approved by Berkeley, our reinsurance company. But as long as they're doing the right things, if they're working for you currently, we expect that they are. And with your brokers, so getting them approved has not been an issue at all. What this kind of does for everybody, though, is it makes it pretty seamless for your employees. All you need to do is you can keep your current plan design, your current program in place, and all we'd be asking to do is to replace your stop loss coverage with the captive, and for your employees it would be totally seamless. So it's a very easy kind of plug and play type opportunity if it fits your needs. key concept of the captive is all insureds are owners, and I've kind of hammered that a little bit, but it's very important. Every member in the program has one vote. It's very democratic the way it's set up. We have committee structures that work with the ownership of the company. The captive is incorporated under Cayman Island law. We're an offshore company, and we'll talk a little further about that. Management of claims is critical. That's why we decided the local program was the best way to go. We think we can take advantage of that. I would say that integrating all the different vendors that you work with is critical. Having your TPA, your broker, your reinsurer, in our case Berkeley, all on the same page when we start handling larger claims is a very important piece. We want to make sure that the plan doc and all that supports how we go about doing that. So it's integration of all those things is very critical. Participation is required. We think that that's critical and important. We want members who want to be involved and to drive the results of their company. Again, it's their dollars, it's their company. It will impact them greatly, and we want people to participate. If it's a good idea and it looks good and you might be able to save some dollars and you're willing to join but you don't want to really work at it, it may not be the best fit for you. We really want people that are actively involved. I'm going to go through this very quickly. There's different options out there currently. This is a fully insured plan. Obviously, you transfer all the risk to the company. You pay a flat dollar amount. Currently, if you're currently self-insured, this is kind of how it looks. Your employee has a deductible and co-insurance. You as the company take on a certain layer of risk. In this example, I'm using $40,000. Over here in red, I'm talking here that you can buy that aggregate stop coverage to handle all your claims below your aggregate. Usually it's about 125% of your expected claims, but you have the ability to buy that with Berkeley, and if you get a quote from us, that will be provided if you choose to elect that. And in your current program, you have your stop loss carrier will come on and take on any claims above the $40,000 up to an annual limit. Most limits today are probably maybe 1 million to 5 million. Eventually, 2014, that's going to be unlimited. Berkeley has quoted for us, 2 to 5 million, and I have actually had some unlimited quotes in this arena. Captive structure, and we'll dig into this a little further, but just to kind of re-emphasize how this works. Again, very similar to your current structure. If you're currently self-funded, you have the deductible. Your company would take on your spec deductible, so you'd be paying $40,000 for every person per year, up to $40,000. And then the captive would take on the next layer of risk. So the captive would come on and take on a $200,000 layer of risk above that 40. So we would be attaching up to 240, and then Berkeley, our reinsurer, would attach at the 240 layer and above up to the annual limit. I will tell you that this 40,000 could be, if it were 100,000, a captive would still take on the next $200,000 layer of risk, and in that example, Berkeley would attach at the $300,000 layer level. So the captive layer can be a floating layer, is kind of how I would explain that, depending on what your spec deductible is. But the captive will always take a $200,000 layer of risk. And this is kind of putting it all together so you can see it. You've got the employee with their share, the company taking on their layer of risk. The company can buy the aggregate if they choose. Berkeley is providing the stop loss policy, and that's critical for the whole program. Behind the scenes, Captive Resource, Well Health Insurance Limited is the reinsurance company, and we're taking on this $200,000 layer of risk. Now, we fund for that layer of risk 3 ways, and that's what this is showing. Every member is going to have a loss fund. The loss fund traditionally, and we've seen a lot of quotes, is approximately 50 to 55% of the spec premium. So today, if you have a spec premium, all right, the captive layer, member loss fund would be approximately 55% of that. We have an element of risk and reward in our program, as I mentioned earlier. Member assessment is that risk portion, and that is 50% of the loss fund. And I'll go through examples later that will show you how that works. So, the member can be assessed up to 50% of the loss fund. If they continue to have losses, they can call risk sharing. This is a very important slide. It points out again that the member has the loss fund, the fund for the layer of risk. We have the experience adjustment, which is that assessment piece. And then we have the ability here in our program, negotiated with Berkeley, that they will protect the captive in any given year if there's losses. So this slide is basically telling you that the captive cannot fail in any given year. Berkeley will provide coverage if the captive layer, we didn't have any dollars left. So the worst case scenario would be every member of our group, we have 21, they were to have very poor years, they would use up all their loss fund dollars, they would get assessed up to the max, so they have no more dollars left, and we continue to have losses in our program, then Berkeley would drop down and they would take on the responsibility of the captive. So the program is protected in any given year. Anytime you're dealing with a alternative funding arrangement, it's very critical that you don't have any, you're not in a program that has unlimited liability. On day one, when you come into our program and you get a quote from us, you'll see what your potential savings can be from a dividend potential. So you'll have your fixed costs, and then you'll have your variable piece. And you'll also be shown what your assessment potential will be, and therefore you'll know on day one exactly what your maximum exposure would be. So you can take a look at that and see if it would make sense in your financial program. The captive is set up so that it's really designed so that any piece within the captive can be replaced. And the example for that and the reason for that is in our casualty world, we had some very big programs within a company called Kemper Insurance Company. And Kemper ended up going out of business. So we had to have a flexible program, a captive flow that would allow us to prepare for some of those situations. So in that world, the reinsurance carrier was Kemper Insurance Company. We were able to replace Kemper with the Zurich or Hartford or whatever carrier, and it was really seamless to the rest of the program. In our case, we work very closely, obviously, with our brokers, and they work closely with your TPA. Your TPA is still going to provide all the services they're currently providing. Berkeley, in this case, is the policy issuing carrier, and they will issue the policies. They work with us, Well Health, and again, Well Health is a Cayman Island domiciled company. It's an offshore company, and the couple of things that go along with that is we require each of our members to buy shares of stock in the company. Our current dollar amount for the stock is $20,000. The stocks are broken up in two ways, common share and a preferred share. The common share is normally in the name of the company, and that is so that they could be responsible for paying the premiums, paying any assessments that were due. So it's usually to handle the obligation of the company. The preferred stock can be put in an individual's name, a family trust. It could go back to the company if that's desired, but it allows allows companies to make a determination of where the dividends go And the reason we have 2 shares, if we only had common shares, any assets that were left at the end of the year would have to be divided equally among the companies that were participating. We want to be able to discriminate in our program. So preferred shares allow us to do that. So if ABC company has performed well and has dollars left in their loss fund at the end of the year, they're going to get those dollars back, and as the result of their work, all right, and they won't have to share those dollars with the other members. If ABC company were to have a bad year and used up all their loss fund, then there would be no dollars left, and they would not share in anyone else's profits. Your TPA will still do the job that they currently do. Berkeley is the ultimate responsibility of the program. Berkeley is A+ rated. They provide the captive aggregate protection, as I talked about, and they also provide each member with aggregate protection if that's what you desire. The next part of the presentation really kind of goes through live examples as to how this program works. What I would tell you, if you're interested, work with your broker. A lot of the companies, as they're taking a look at it, will go back 4 or 5 years. They'll run it through the different formulas that I'm going to show you for each year, and then you can determine whether this would have been a good fit for your company or not. Usually what happens is if you're making money for the stop loss carrier over a 4 or 5 year period of time, those profits are going to the stop loss carrier currently. But if there's enough dollars there, then this makes sense. The companies that have been losing money for the stop loss carrier over that period of time and don't know that they have things going forward that they're comfortable with, they're not going to come into our program. And the reason they're not is because we have that assessment piece. If they perform badly, we have that risk element, that punishment phase that will make those guys pay a little bit more dollars, again, a known amount, but they will be penalized before they would cause any risk sharing. And that's important to understand. Is the way the program is designed is we return dollars if you perform well. If you don't, you're going to pay a little bit more before you would cause any risk sharing with any other member. So there's actually a little bit extra protection for the other members before there's any risk sharing being caused. So let's go through a couple examples. ABC company has an $80,000 spec deductible. Their premium as a result of their underwriting is they have a stop loss premium of $420,000 in our example here. As I said earlier, the loss fund is going to be approximately 55% of the stop loss premium. And the operating cost, which is the fixed cost, is the remainder. So in our example here, $250,000 is going to be allocated to the member's loss fund to pay for those losses above the spec in the captive layer. The operating costs are $170,000, and we'll see how it plays out when we have claims throughout the year. Our first example here, this shows you how the split is. You have the spec deductible 80, the captive takes on 250, and the reinsurer connects at the 280 level. Here's an example of the loss. In this particular year, we have one claimant in excess of the $80,000 spec retention, and that claimant generated $120,000 of losses. So running our formula, the carrier or the employer pays the 80, that's his spec deductible. So the remaining dollars is $40,000, and that goes to the captive layer. So coming down into our accounting, our beginning balance, as we pointed out, the fund had $250,000 in it. We have a captive layer losses at the end of the year of $40,000, so we have a remaining balance of $210,000. So at the end of the year, this company has the potential to get $210,000 back. This is without any risk sharing, and keep that in mind, and I'll show you an example of how that may work later. Here's an example with multiple claims. And again, we'll just kind of walk through it very quickly. Claimant 1 has $130,000, $80,000 responsibility of the employee, $50,000 left that goes to the captive layer. Claimant 2, $110,000, $80,000 to the member, to the company, and the remaining balance goes to the captive layer of $30,000. Again, we have a beginning balance of $250,000. The captive layer is responsible for the $80,000. The remaining balance is $170,000. So in our example again, there's dollars left over. At the end of the year, this company would be eligible for a potential dividend of $170,000. Again, risk and reward program. Here's an example where we have a catastrophic claim. We have one claimant that hits that $1 million claim. The employee pays the first $80,000. The captive is responsible for a $200,000 layer, so we're going to take $200,000 on this claim. And the reinsurance company, Berkeley, would step in and pay the remainder, $720,000. So coming down and seeing how this works, the loss funding, we started at the beginning with $250,000. We had claims of $200,000. Our remaining balance is $50,000. So even with a $1 million claim in this particular example, this company would still have a potential dividend of $50,000 at the end of the year. Example 4 here is an example of risk sharing. And again, this would give you a pretty good idea of how it all would work out. ABC company has 3 claimants. First with $130,000, it's going to leave a $50,000 layer for the captive. Claimant 2 has $230,000 claims, $150,000, and claimant 3 has $500,000 a claim. Captive layer is responsible for the $200,000. The reinsurer is going to take on the next $220,000. How the funding works and how the accounting works at the end of the year, we started out with $250,000 in our funding. In our case, in this year, we had $400,000 worth of captive losses. So we have a deficit this year in our funding of $150,000. We talked about the assessment potential, and here's where it plays in. We're going to assess ABC company 50% of their original loss fund. So in an example, they had $250,000 loss fund. They're going to be responsible up to the max of $125,000. So they pay those dollars out. So that protected the other members of the group to that degree. However, we still have dollars left. So as I told you when we started at the beginning of the day, when you get a quote from us, you're going to know what your maximum exposure is. So in this example, the maximum exposure for this account was his premium that he paid at the beginning of the year plus $125,000 of his assessment. So in this case, he's done. He's used up all his dollars. He's paid his max. He has no dollars left available to pay any more dollars. He's capped. So the other members are going to have to step in, and this causes risk sharing. So in this example, we have $25,000 that will be shared among the other members of the program. And currently, we have 21 members, so this would be divided by the 20 members. And it's done on a prorated basis depending on the size of your loss fund. So every company would have a little different piece of it. But if it was equally spread, we just spread it that way. The assessment for this individual, this account, we will be sending out a bill for that assessment at the end of the year. Our program in the captive has a 10/1 effective date for all of our members. So members that come into the program, we will line up the stop loss to have a 10/1 effective date. And the reason we did that was we needed to give 30 days, 90 days or so for run out on any particular program. We want to be able to close our books by 12/31. We want to make sure all the financials are done. and that we can report back to the board of directors, who are the members of the company, in our meeting that we have every March. So there'll be an accounting done every March at the board of directors meetings. The year should be closed at that point, and there'll be an accounting for everybody. Every member of the group will get an accounting and know exactly where they stand at that board meeting. But assessments will probably go out after the board meeting, and they would be due. Now, because our program has an element of risk and reward, we're going to require for that upswing, all right, that 50% of the loss fund, which is the upswing above what you might pay above your premium on the spec premium. For that upswing, we got to protect everybody. So we require a letter of credit or cash to collateralize that upswing. So in our example back here, the ABC company, they had a potential assessment of $125,000. We would require a letter of credit or cash in that amount to be put up front and to be put aside. So the cash or letter of credit is posted at the beginning of the year at the 10/1 date, and it's held in an account in the name of the company. Any interest that's earned is being held for them, and the collateral is put aside only to protect the other members. So the example would be if ABC company came into our program and had $125,000 assessment due, and we didn't have the collateral for that. If he decided to walk, we would have that. We'd still have to pay the claims, and we'd have that responsibility, and we'd have to go back to the other members to collect that. Because we don't want that to happen, we have the collateral in place to protect members from each other. We do not want members to have to absorb any bad debt. Our collateral requirement is 50% of the loss fund in the first year. So in our example, that was $125,000. The second year, after we did our review of underwriting and we quoted it up, if his loss fund was exactly the same, we would require another $125,000 in the second year. What we're going to eventually do is have a 2-year rolling average as the loss fund, as the collateral requirement. Year 3, we're not going to have to collect any more dollars unless the loss fund might have to be topped off, but it also could be reduced depending on the loss fund. So it is a 2-year rolling average, again, to protect each of the members. Now in the casualty world, companies are pretty much aware, they've done that for years. If they have retros or high deductibles, they might have to have a letter of credit. On the benefit side, this is relatively new. On a positive note, the way we look at this is that the companies that are coming into our program, number one, because we have a stock purchase, we also have this collateral requirement. We kind of expect the members that do join to be financially sound, because they're not coming in if they're going to not be able to post these dollars. If they are financially sound, what we're seeing is they have a ability to budget for wellness. They have already kind of done the right things. They may have already gone down the wellness path a great deal. That's why they've been so successful in making money for the stop loss carrier. So because we have the collateral, it's kind of a cut for us. We know that, a lot of companies may not want to participate because of it, but we also know the ones that do are going to be the ones that we want. They're going to be financially sound. They're going to have money and resources to kind of put into this, to kind of help drive their results. The stop loss premium itself, we know, is a very small percentage of the total dollars spent. All right, and that's why that slide we were talked about, what's going to keep us together is we're all focused on trying to minimize and reduce the dollars below your spec level. That's where 90% of your dollars are spent. So our whole program, our whole thought is working together, working with the other members, sharing those ideas, trying to help us drive those results at the layer below the spec deductible. What we think long term is that this will give you control of what's going on in the marketplace. If you're not self-funded, over the next 5-10 years, it's hard to imagine exactly how that's going to look. We know it's going to change tremendously, and it will continue to change. We know it's going to be expensive, so we're thinking that the companies that will be joining are companies that want to be taking control of their destiny a little bit, working on health management issues. We're going to try to lower those operating costs for you within our program. We expect to return dividends. At the end of the day, the people coming into our program, because we know they're going to be on the cutting edge, they're going to be driving results, our book of business is going to perform better than the average in the marketplace. So as we get larger and get bigger, and we have more success, and we're able to demonstrate that, we are going to have, I believe, significant leverage within the marketplace. As our casualty books, we have some captives that have excess of $100 million in them. They work with reinsurance companies, and when they renew, they have a tremendous amount of leverage, especially since the results are very positive. And we kind of expect to have that same leverage as we go forward. Remember, any investment income, whether it's on the collateral or dollars that are being held, will be accrued and back to you. Captive resources, with our experience, and really why we're in the well health aspect of it, is because our members came to us and said, listen, you guys have performed well for us on the casualty side. We really need help on the benefit side. This stuff is getting out of control. We're looking for help. So we spent a great deal of time and effort, as you can imagine, as I'm putting together this program. I have to be conscious of the fact that I've got $1 billion of casualty business at risk. So my program is designed to be very conservative. I took that into account. I made sure that I didn't have the ag coverage within our program. We have a risk-reward model. We have assessment potential that protect our other members from each other. It allows us to be pretty comfortable that we're going to outperform the market because our members are going to be doing the right things. Kensington Management Group is our sister company in the Cayman Islands. It's our financial piece. Every year we will have an audited financial. Kensington Management is responsible for that. They put together our program when we got started. So it's they've got probably 25 employees in the Cayman Islands, kind of foot on the ground. They're all accounting and financial people. So they work with the Cayman Island authorities and make sure that everything's in place. And again, we have a long-standing relationship in the Cayman Islands and the Cayman Island Authority with our casualty programs of close to 30 years. EPIC is a property program. Again, this was put together because our members wanted us to do something. They came and asked us to do something on the property, so we put together a program, captive on the property. This captive investors fund on the casualty world, there's a lot of dollars that are sitting because tails may be 5, 6, 7 years, and there's a lot of dollars in a lot of these programs. Again, $1 billion of business running through our captives. We have some dollars that we're holding. Our members wanted us to invest it for them because they were not getting returns that they would like. So we put together this fund for our members. It's privately managed independently of us. And currently that investment fund's got about $1.6 billion of our members in there. So we put together purchasing programs for the well health here recently. We had a third-party vendor come in and go through and review everyone's plan document, all of our members' plan documents. It was a third-party independent. It was free of charge for our members. One of the benefits that we provided, we thought it was very important that everyone take a very proactive look at their plan docs, because it's important that that dictates an awful lot as to how claims are going to be handled and how that integration with your TPA broker and so forth works. So we spent time and money to do that. We also have a patient advocacy group that we introduced to our members Again, each of the members can participate in that. It's free of charge to the members. The key ingredient here is that it goes down to the employees. I have an employee at my company that has an issue, maybe a large case, something that may be coming down the pike. He has a ability to call a third-party independent person to kind of walk them through what to expect, how it's going to work, what type of procedures they may be looking at. Again, it's just another form of trying to help the members and to focus on different initiatives. And these were all driven by the members at the different board meetings and at the recent workshop. What's next for us? If you're interested, deal with Brooke here, and Brooke can work with you on getting the information that would be necessary to take a look at our program. It's currently pretty much the same information that you would need to get any other stop-loss carrier. What I can definitely tell you is that our stop-loss program and our pricing has been very competitive in the marketplace. What it really comes down to is whether you see value in working in a group of like-minded companies that are trying to drive results and potential for that risk-reward element. If you guys are performing well, it would make a lot of sense that this would be something you would consider. So with that, I'll try to answer any questions. Rob, my question area is blank, unfortunately. Can somebody read the questions maybe to me?
Thank you very much, Jim. We appreciate it. It doesn't look like there are any questions right now.
I'd be more than happy to answer.
A very technical subject, but something that is really needed right now. Any resource that anybody has in solving these employee benefit issues right now is of benefit. So if you'd like for us to follow up with you, please give us your contact information in the box, and we can get you some more information. And always, AFR is available for any questions that you have. Their information is all over our website, and also will be provided here at the end of this webinar. So, Brooke, I'm sure you'd be happy to answer any other questions that they have there.
Is there
At this time, I'd like
any questions anybody has?
everyone for the opportunity. Brooke, in your group, I appreciate you taking the initiative.
Great session and pretty explanatory. So,
ABI, appreciate the time
thanking
and the
ABI.
effort. Thank you all, and with that, I'll turn
thank
it
you,
over.
Jim. It was a pleasure having you here today. I just wanted to give you a reminder of some events that are coming up here at ABI. We've got our next webinar, the 22nd, and this is really a reflection of a request that we had from some of our members. There are a lot of executives that get put into their positions without much financial training. Some of them don't know how to read a statement of revenues or a financial statement, and it really is helpful in knowing the ins and the outs of the company if you can actually read those financial statements. So we're going to have a session, a primer basically, on how to read a financial statement. So that will happen on August 22nd here at 9 o'clock. August 29th, we are doing an executive workshop in Carroll, Iowa, and that session will be all about transitioning your business. So please join us for that. That will be live there at the Swan Lake Education Center from 8 to 3 in Carroll. And then on September 13th, one of ABI's most popular events, that's our Executive Open at the Harvester again this year. They did such a great job for us last year that we're going to go back this year. We've got about 20 slots open, so if you are going to register for that, do that now. And then in November, we begin a series of 5 Connecting Statewide Leaders receptions, and these receptions are solely, exclusively created to provide networking opportunities in those regions. And the networking is between young professionals, Leadership Iowa students and alumni, ABI members, and then we've also partnered with local chambers so that we've got local business leaders there as well. So they are free of charge. They take place right after work, and it's an opportunity to gather. have a beverage and some snacks, and hopefully exchange some business cards. So those will be coming up again November 8th. Our first one is in Fayette at Upper Iowa University. So looking forward to that. So thanks so much for joining us. And again, thanks to my intranet, to Chrissy Blake and Brooke, and of course Jim for that great